Welcome to the deep dive. We're jumping straight in today. We've seen this significant increase in tariffs globally, especially from the US, and it's really shifting things.
Yeah, it absolutely is.
So our mission really is to get straight to the point. What are the core economic impacts globally and right here in the US?
Exactly. We've got data from places like WTO, the IMF, historical figures, expert opinions. We're going to cut through the noise.
Good. Let's focus on those fundamental consequences for businesses, for you, the consumer.
Let's do it. Where should we start? Maybe e-commerce. They're right on the front lines.
Yeah, good call. So tariffs, they're basically taxes on imports, right?
Fundamentally, yes. And for e-commerce businesses operating internationally, that means higher costs, straight off the bat.
But it's more than just the initial cost, I imagine.
Oh, definitely. Think about the knock-on effects. Your profit margins get squeezed. Your supply chain, which is probably already complex, gets even trickier.
And pricing becomes volatile.
Very. One day a product costs X, the next with a new tariff, it's Y. It makes planning incredibly difficult.
And for the customer, longer waits for stuff. Frustration.
That's a big part of it. Order fulfillment timelines get disrupted.
Yeah.
And customers get frustrated. Businesses then have to rethink everything, product lines, who they buy from. It adds huge operational complexity.
So if you're importing finished goods or even just parts, you're hit.
You are. And the unpredictability is the real killer for long-term strategy.
Yeah.
Do you wait and see? That's risky. You could lose market share, lose revenue.
Sounds like a paralysis trap. But businesses can't just stop, can they?
No, they have to adapt. They still control things like, operational efficiency, their marketing, customer service. They have to double down on what they can control.
Is that where things like strategic hiring come in? Maybe bringing in freelancers with specific skills?
Precisely. Suddenly you need someone who's an expert at finding vendors in, say, Vietnam instead of China, or someone brilliant at negotiating new terms or rerouting logistics.
Or even just handling the increased customer queries about delays and prices.
Exactly. Marketing needs to be smarter, maybe focusing on value over just price. Customer support becomes even more critical.
And this isn't just a U.S. problem, is it, given how global e-commerce is?
Absolutely not. If you're a business anywhere in the world selling to the U.S., or even sourcing from U.S. suppliers who might face retaliatory tariffs, you're caught up in this.
The U.S. government gives reasons, of course, protecting local industries, unfair trade practices.
Right, those are the stated goals. But the tariffs on goods from China, the EU, elsewhere, they've created real tension in global supply chains, undeniably.
So if I'm, say, a European online brand, what hits me?
Okay, several things. One, your own country might hit U.S. goods with retaliatory tariffs, so if you import anything from the U.S., your costs go up.
Okay.
Two, if you ship goods to the U.S. that originally came from China, for example, you'll face those U.S. tariffs directly.
Right.
Then there are the supply chain hiccups, delays, maybe needing new routes, and just more paperwork, more customs headaches.
So you're stuck choosing between absorbing the cost, which hurts profits, or raising prices and potentially losing customers.
That's the dilemma. For some, maybe bigger brands, they might look at diversifying suppliers, moving production, but that's complex, costly, not always feasible for smaller players.
And meanwhile, U.S. consumers might be changing habits, buying less, looking local.
We're seeing signs of that, people cutting back, maybe looking for alternatives made domestically if they can find them.
So that example you mentioned, the European shoe brand using Chinese manufacturing to sell in the U.S., they're in a tough spot.
Very tough. Or think of a Spanish winery exporting to the U.S., suddenly facing higher tariffs. Maybe seeing orders drop off. It happens fast.
It really underscores how tariffs can just overnight change the game for pricing, profits, logistics, growth plans.
Flexibility and being able to pivot quickly are absolutely crucial now. The U.S.-China tariffs especially have forced major rethinks in supply chain strategy, even impacting things like the de minimis threshold.
The level below which imports are duty-free.
Exactly. Changes there have big implications, particularly for low-cost, high-volume items.
Which specific types of goods are feeling this most acutely?
Well, consumer electronics are definitely up there. Auto parts, apparel and footwear big time, home goods, appliances, and basic materials like aluminum, steel, plastics.
So even if you assemble products in the U.S., if your components come from China, your costs are rising.
Absolutely, which flows through to sellers on platforms like Amazon, Shopify, eBay. Their wholesale costs go up.
Squeezing margins again forces them to raise prices or look elsewhere. Vietnam, India, Mexico getting more attention.
Definitely. That traditional model of source super cheap from China, sell online, is becoming much less straightforward. Businesses are facing delays, needing to renegotiate constantly with suppliers.
And you mentioned consumer behavior changing too, maybe buying used or just waiting longer to buy?
Yeah, potentially. A preference for domestic alternatives if available, maybe more interest in refurbished goods. Sales cycles might slow down in some areas.
And the logistics. Sounds like a nightmare. Higher shipping costs, more admin, customs delays.
It all adds up. Higher landed costs, more warehousing, needs maybe closer to customers to cut delivery times. It's a significant administrative burden too.
So fulfillment centers closer to the end customer become more important.
Could be part of the strategy, yes. Fundamentally, these tariffs are forcing a rethink of the entire e-commerce model. Pricing, supply chain, even how you find customers. But, crisis can breed innovation.
True. Opportunities for efficiency, new suppliers.
Exactly. But it's undeniable that small businesses doing international manufacturing or cross-border sales are particularly exposed right now.
Because those tariffs hit them directly on imported goods, components, even packaging.
Right. And potentially their customers face higher duties too if those duty-free thresholds change. It makes competing on price, especially on big marketplaces, really hard. Even a domestic manufacturer using imported materials feels it.
Okay, so if a business is facing these rising costs, what are the main strategies? You mentioned negotiation.
Yeah, that's number one. Talk to your suppliers. Can they absorb some of it? Can you find shared ground? Don't underestimate your leverage, even as a smaller business, especially if everyone's facing the same issue. Having alternative suppliers lined up helps, of course, unless you've prepaid everything.
Makes sense. What's option 2?
Absorb the cost yourself. Take a hit on the margin. How much you can do depends on your current profitability, obviously. It can work short-term to protect your price point and sales volume. Best for high-margin items or where customers are super price-sensitive, but it's a trade-off long-term.
A tough balancing act. And the third? Passing it on.
Passing the cost increase to the consumer. Raising prices. This is easier if, frankly, everyone else is doing it too, but how you do it matters. Gradually. Only on certain products. Introduce new tiers. Maybe bundle things differently.
Communication seems key there.
Absolutely. Being open about why prices are rising, maybe mentioning supplier talks, can help. Offering temporary promotions might ease the blow. Advance notice is good too.
So most businesses probably end up using a mix of these.
Almost certainly. A hybrid strategy tailored to their specific products, margins, customers. But the big picture is clear. These U.S. tariffs have caused significant disruption globally for e-commerce.
We're seeing broad duties, higher rates for specific countries, hitting sectors like U.S. fashion that rely on complex supply chains through places like Vietnam, Cambodia, Bangladesh.
Right? And you see it reflected in stock prices for major retailers who are scrambling to manage these costs, absorb or pass on.
And it affects how people buy things, maybe buying big items sooner if they expect prices to rise further.
That can happen initially, yeah. But the longer-term trend is likely slower sales, more careful spending. And the international reaction has been strong. The EU talking countermeasures, China and others already retaliating.
Raising those fears of protectionism, even a trade war.
Exactly. And specific sectors, like fast fashion, are really vulnerable if that de minimis exemption goes away entirely. Experts are pretty unified in predicting general price increases in the U.S., a significant hit to the average household budget per year, adding to inflation risks and increasing recession odds if tensions keep escalating.
So to recap the e-commerce impact, higher product and shipping costs, disrupted supply chains, volatile pricing, changing consumer habits, squeezed profits, de minimis changes adding pressure, higher operational costs, forcing strategic shifts, and just a lot of market uncertainty.
That sums it up well.
Okay, let's widen the lens. How are these tariffs impacting global consumer prices and inflation more broadly? The consensus seems pretty worrying.
It really is. Most economists agree these tariffs will mean higher consumer prices worldwide. We actually have data from the 2018-19 round of U.S. tariffs showing significant price increases on consumer goods in the U.S., and those costs were passed on almost completely within just a couple of months.
So it happens fast.
Very fast. And recent data from early 2025 suggests a similar pattern. Maybe a partial pass-through, contributing to core inflation measures already.
So businesses are passing these costs on, contributing to overall inflation.
Yes. Manufacturer surveys confirm they expect to raise prices because of the trade situation. The public expects it too. Big players like Goldman Sachs project a rise in core inflation, especially hitting things like electronics and apparel.
Because tariffs are essentially taxes paid by importers.
Who then typically pass that cost along to consumers. Yes. Estimates suggest this could add a noticeable amount to the average American household's annual expenses.
It's a double whammy, isn't it? Higher prices for consumers and potentially lower demand and profits for businesses that rely on those imports.
Exactly. And while tariffs might make companies look for cheaper suppliers, they only really shift production domestically if the tariff makes producing at home the absolute cheapest option. Otherwise, it's just an added cost, fewer choices for consumers, like a tax hike, without necessarily bringing jobs back.
So prices go up. The range of products might shrink if some just become too expensive to import.
Correct. And because supply chains are so global and complex, that tariff cost gets embedded deep within the final price of many, many goods. You might not see tariff surcharge on the label, but it's baked in.
Affecting everyday items, PlayStations, car seats, clothes, coffee, cars.
Potentially, yes.
Yeah.
The U.S. weighted average tariff rate has jumped significantly, reaching levels not seen in decades.
Okay, that sets the stage for inflation concerns. Now, what about the World Trade Organization? How do they see global trade shaping up in 2025?
The WTO is sounding pretty loud alarm bells. They're forecasting a significant weakening in the outlook for global trade this year. They actually expect global merchandise trade to contract.
A contraction compared to growth last year.
Yes, a sharp deterioration. They point directly to the surge in tariffs and the general uncertainty around trade policy from major economies as the key reasons. North America is expected to be hit particularly hard, with a significant drop in exports predicted.
And if tensions escalate further?
It gets worse. More tariffs, more uncertainty. It would deepen the decline. They've also lowered their forecast for services trade growth, expecting slower expansion there too.
The WTO Director General sounded quite concerned.
Deeply concerned. This ongoing policy uncertainty is seen as a major threat to global growth, especially for more vulnerable developing economies. Their analysis is clear. The recent policy shifts, the new tariffs, are directly responsible for the big downgrade in the world goods trade outlook.
Forecasting must be incredibly difficult right now.
Hugely. We don't have much recent precedent for such widespread tariff hikes. But the WTO's models predict a contraction in global real goods exports and a hit to global GDP for 2025, with a big chunk of that driven purely by the policy uncertainty itself.
And services trade gets dragged down too.
Indirectly, yes. Slower overall economy, less goods trade. That means less demand for transport, logistics, intermediate services. They see most services growth coming from Europe, some in Asia, but a definite slowdown in North America.
A huge shift from last year's picture.
A very significant shift. And while the WTO's core principles, like most favored nation, are mostly still there, this tariff surge is a big departure from decades of liberalization.
And the WTO already pointed out that developing countries often faced higher tariffs anyway, right?
Correct. This new wave risks hurting them even more, discouraging them from moving up the value chain. The whole environment signals disruption and a potential reversal of gains made through freer trade.
Okay, the WTO's view is quite somber. How does the International Monetary Fund, the IMF, analyze these tariff effects?
The IMF's analysis is very much in line with the WTO's. They see the tariffs as a significant risk, and they've also revised their global growth forecasts downwards because of them.
They made a striking comparison about the U.S. effective tariff rate.
Yes, they highlighted that it's surged past levels seen even during the Great Depression, and retaliatory tariffs are pushing up the global average too. The trade policy uncertainty is a major driver of their current gloomier outlook.
So the uncertainty itself is a drag on growth.
A major one. Their forecasts, which factor in the announced tariffs and counter-tariffs, show reduced global growth for this year and next. It's not just the direct cost of tariffs, but also how that uncertainty hits business investment and consumer confidence.
The IMF talks about tariffs acting as a negative supply shock for the country imposing them. What does that mean in practice?
It means tariffs distort the economy. They make imports more expensive, so resources shift towards potentially less efficient domestic industries that are now protected. This lowers overall productivity and pushes prices up. Medium term, they expect less competition, less innovation, more companies trying to get favorable rules instead of becoming more efficient.
And for the trading partners on the receiving end?
For them, it's mainly a negative demand shock. Their customers in the tariff-imposing country buy less. Some might gain a tiny bit if trade gets diverted their way, but the net effect is negative. Interestingly, the IMF actually lowered growth and inflation forecasts for places like China, seeing a deflationary impact there.
So basically, nobody really wins, according to the IMF.
That's the gist. The uncertainty hits everyone. Businesses pull back, financial institutions get nervous, it ripples through supply chains, kind of like we saw during the pandemic, but for different reasons.
Do they predict a global recession?
Not in their main forecast, no. They still expect growth, just slower, but they stress the downside risks are much higher now. If trade tensions ramp up further, or if financial conditions tighten, the chance of a real downturn increases significantly.
And for the U.S. specifically, what did the IMF project?
They lowered the U.S. growth estimate for this year significantly, blaming a good chunk of that on the tariffs and related disruptions, and they revised the U.S. inflation forecast upwards. The Eurozone sees a smaller growth cut as tariffs affecting them are lower, but many emerging markets could face quite substantial slowdowns. China's growth forecast was also cut due to trade policy and weaker domestic demand.
So the overall IMF message mirrors the WTO. These tariffs are bad news for the global economy, and we need stability and cooperation.
Exactly. A stable, predictable trade environment is what they're calling for.
Okay, let's drill down specifically into the impacts on the U.S. economy itself. The forecasts seem pretty stark.
They are quite concerning, yes. We're talking significant projected hits to GDP growth, consumer prices, and household income. That Yale Budget Lab analysis you mentioned earlier, they calculate the average effective U.S. tariff rate will be the highest since 1909 after all the 2025 tariffs are in place.
Wow, 1909. And they project higher prices, hitting lower-income households hardest?
Yes, a rise in the overall price level, translating to a substantial average loss per household annually, with the burden falling disproportionately on those with lower incomes. Certain sectors like clothing and textiles are expected to see particularly noticeable price jumps.
And the impact on overall economic growth, GDP.
Negative. A reduction in real GDP growth for 2025 and a lingering negative effect long term. Basically, a persistently smaller U.S. economy than it would have been otherwise, losing significant output each year. U.S. exports are also projected to take a big hit in the long run.
So even if the government collects more tariff revenue initially,
the drag on the overall economy likely outweighs it. Yale projects those initial revenue gains will be partly offset by lower tax receipts from a slower economy, what they call negative dynamic effects. The Tax Foundation agrees, predicting lower GDP, lower after-tax income, and a big drop in imports.
What about other organizations? The World Bank.
They also warned these tariffs could really hinder global growth, and they'd cut their U.S. growth forecast significantly if partners retaliate strongly. Deloitte's model shows slower consumer spending, potentially severe impacts if these high average tariff rates stick around.
And the Penn-Wharton budget model, their projections sound even more severe.
They do project more substantial negative impacts, yeah. Significant long-run hits to GDP and wages, a big lifetime income loss for middle-income families, and potential knock-on effects like less foreign investment and lower demand for U.S. debt. So the consensus picture for the U.S. is lower growth, higher costs for consumers, and disruptions.
Let's talk specifically about U.S.-China trade. That relationship seems particularly strained right now, with tariffs up to 145% on some goods.
Extremely strained. Those high tariffs hit China's export-driven economy hard, especially since it's already dealing with issues like the property sector downturn. China, in turn, hit back with tariffs up to 125% on U.S. goods and basically stopped buying most U.S. farm products.
What's been the effect on trade flows?
A big drop in Chinese exports to the U.S. But interestingly, a surge in China's exports to other places like Southeast Asia. This really suggests the U.S. tariffs are speeding up that supply chain shift away from China. We hear reports of U.S. retailers canceling China orders because costs are just too high.
So trade is redirecting?
It seems to be. China's exports to places outside North America are expected to keep growing. The U.S. is still a huge single market for them, but its share of their total exports has fallen. The EU and Southeast Asia as regions are bigger markets now.
And for American consumers, higher prices on Chinese goods are inevitable.
Seems likely. Things like electronics, clothes, toys. Estimates suggest potentially big price jumps for specific items like smartphones or game consoles.
And that Yale analysis showed China's share of U.S. imports falling as businesses and consumers substitute away.
Yes, they substitute, but often to alternatives that might be more expensive or have different features. And despite early claims that China would pay the tariffs, the overwhelming economic analysis concludes the cost falls largely on U.S. consumers and businesses.
Plus, the uncertainty about how long this lasts, or if it gets worse, hangs over everything.
Absolutely. That uncertainty dampens business confidence and investment.
It's useful to look back at history here. You mentioned Smoot-Hawley in 1930.
Yes, it's the classic cautionary tale. High tariffs meant to protect U.S. farmers and industry during the Depression. What happened? Immediate harsh retaliation from trading partners. Global trade collapsed. It made the depression much worse. It's widely seen as a massive policy mistake, a lesson in the dangers of protectionism.
What about the U.S.-Japan trade friction in the 80s? Any lessons there?
That was different, focused on specific sectors, like semiconductors, cars. The U.S. used tariffs due to trade imbalance concerns. Japan eventually agreed to some export limits, but the trade deficit didn't really go away. Many argue the situation resolved more due to Japan's own internal economic issues, their asset bubble bursting, rather than the tariffs working effectively.
So tariffs might not be a silver bullet for complex economic problems.
Often not, especially when wider global factors are at play. History really shows tariffs can easily backfire, trigger retaliation, disrupt trade, and have significant negative economic fallout.
Governments sometimes try controlling prices directly, too, not just through tariffs. How do those historical examples compare?
It's a different tool. Direct price controls versus tariffs affecting import prices. But history offers insights into the complexities and unintended consequences of any major price intervention. Think about U.S. price controls during World War II.
Did they work?
They helped stabilize some things, but also led to shortages, black markets, rationing, or the gasoline price ceilings during the 70s oil crises. Long lines, worse shortages. Nixon's wage and price freeze in the early 70s seemed to work initially, but inflation surged back when they were lifted.
So economists are generally skeptical about price controls.
Generally, yes, especially broad, long-term ones. They distort market signals, lead to inefficient resource use, can stifle growth. The lesson is that messing with prices directly, whether through controls or tariffs, involves big trade-offs and often creates new problems.
Ultimately, how consumers react to these added costs from tariffs is crucial.
Absolutely critical. And today, consumers are very aware of prices. You can compare online, in-store, instantly. They'll likely notice tariff-related hikes.
But price isn't everything, is it? Value matters too. Quality, brand.
True. Price is huge, but perceived value is key. If a business can still communicate strong value, better features, great service, strong brand, they might mitigate some impact. People might pay more if they feel they're getting more.
But generally, people are sensitive to price increase.
Very much so. Research shows that. And if these trade tensions drag on, it can really hit consumer confidence, make people cut back on non-essential spending. You might see some initial stockpiling or people delaying big purchases.
How much buying habits change depends on
a lot of things.
Yeah.
How big the price jump is, are there good alternatives, how's the household budget looking, and again, that perceived value.
Okay, let's summarize the arguments for and against tariffs. There's obviously a debate.
There is. Proponents argue tariffs generate government revenue. They can protect domestic industries, potentially boosting production and jobs at home. They can be used strategically against unfair practices like dumping. Some argue they enhance national security by reducing reliance on foreign goods, and they might encourage firms to reshore.
And the arguments against?
Opponents stress they increase costs for importers, leading to higher consumer prices, hitting lower-income folks harder. They harm businesses that need imported parts or materials, making them less competitive. They provoke retaliation, hurting exporters and leading to trade wars. They cause inefficient resource allocation, potentially hurting growth and costing jobs elsewhere in the economy. And the uncertainty deters investment and confidence.
How have politicians and business leaders reacted to the recent moves? It seems mixed.
Very mixed. You hear optimism from some, especially within certain political groups, about long-term benefits like jobs returning. But there's also widespread concern across the political spectrum and definitely in the business world about the immediate financial hit to consumers and companies.
Business leaders sound anxious.
Many are, yes.
Yeah.
Worried about rising costs, supply chain chaos, the general uncertainty. Some companies have reported direct negative impacts, maybe freezing hiring or pausing investments.
There is that incident with Amazon potentially displaying tariff costs.
Right, that highlighted the political sensitivity. Amazon considered it, the White House called it hostile. Amazon denied it was for the main site. It shows how careful businesses feel they need to be when commenting on policy. Some politicians then called for other companies to display the costs.
So a blend of concern, uncertainty, and a politically charged atmosphere.
That sums up the reaction pretty well.
So as we wrap up this deep dive, the overall picture seems clear. These recent tariffs are having significant, mostly negative impacts, both globally and in the U.S.
That's definitely the consensus view emerging from the data and analysis. E-commerce disruption, higher consumer prices, slower global trade, reduced economic growth projections. It's hitting across the board.
And the warnings from the WTO, the IMF, plus looking back at history, they all underscore the risks and the uncertainty involved.
They really do. It serves as a strong reminder that these policies have far-reaching and often unintended consequences.
I think the key takeaway really is that tariffs, whatever the intention behind them, are blunt instruments with complex, often negative effects that tend to show up pretty quickly.
Well put. They're rarely